Our next topic is CGT reliefs for individual. And the first relief is private residence relief. It applies when an individual disposes of a dwelling house which has at some time during their ownership being their only or main residence. Means if he has more than one residence, he has to inform the HMRC which one is his main residence. The gain is said to be exempt if the period of ownership is equal to period of occupation. Otherwise, relief is calculated. First, you have to calculate the gain on the disposal of property, then compute the total period of ownership and period of occupation. Remember, again, if period of occupation is equal to period of ownership, the whole gain is exempt. If the period of occupation is less than period of ownership, you have to apply the formula for the calculation of PRR, and that is gain multiplied by period of occupation divided by total period of ownership. Then after calculating the PRR, deduct this from the gain. Period of occupation is said to be actual occupation plus deemed occupation. And deemed occupation means last 9 months period, last 9 months of ownership or up to 3 years of absence for any reason is count as deemed occupation. Any period spent living overseas due to employment is also deemed occupation, while up to 4 years of absence as a result of working elsewhere in UK is also considered as deemed occupation. But remember that from point B to D, it must be preceded and followed by a period of actual occupation. Otherwise, this period of deemed occupation would not be considered. This is about ownership of more than one residence. Then an individual has to inform the HMRC in writing to notify them which residence is their main residence. Then it is about business use. If an asset is or part of asset is used for business purpose, then PRR is restricted. PRR is only provided on a private residence. So, for example, on 30th June, Alex sold his house for 1,25,000, resulting a gain of 70,000. The house had been purchased on 1st July 7, and one of the 5 rooms had always been used for business purpose. So, this 1/5 portion of gain would not qualify for private residence relief. So, this become chargeable gain. The 1/5 of the total gain become chargeable. Remaining is said to be PRR relief because the period of ownership and period of occupation is equal. The whole gain should have been exempt, but because of the reason that 1/5 of the house is used for business purpose, there is a chargeable gain of 1/5 of the total gain. Letting relief is calculated by comparing 3 things. First, 40,000. Second, the amount of gain exempted by the normal PRR rules, means PRR. And third, the part of the gain attributable to letting period. And to calculate the part of the gain that is attributable to the letting period, the formula would be the same. Gain multiplied by letting period divided by period of ownership. An important point in this regard is that if the owner has a lodger who lives as a member of the owner's family, sharing the accommodation and taking the meal with them, then full PRR will be available and letting relief will not be considered. So in this illustration number 3, test understanding number 3, they have mentioned here that the tenant did not share any living space with alienee. So letting relief will be calculated. While in this illustration, Pooja rented a room in the house out to a tenant who was free to use any part of the house and who took meal with Pooja. So no renting relief is available. Now it is about business asset disposal relief. The rate of tax on business disposal. Such business disposal which qualify for business asset disposal relief, it is 10%. The operation of relief is such that the first 1 million of gain on qualifying business disposal is taxed at 10%. Doesn't matter what is the level of taxpayer's income. Any gain above 1 million will be taxed at normal rate, individual's income tax rate. Gain qualifying for BADR are set against any unused basic rate band before non-qualifying gain. What does it mean? It means if you are claiming BADR relief, you have to sacrifice the benefit of unused basic rate band. The 10% CGT rate is calculated after the deduction of allowable losses and annual exempt amount. The relief must be claimed within 12 months of the 31st January following the end of the tax year in which the disposal is made. It means if a disposal takes place in the tax year 21-22, the claim must be made by 31st January 24. Qualifying business disposals means the whole or substantial part of business carried on by the individual either alone or in partnership. Assets of the individuals or partnership trading business that has now ceased. Shares provided if they are of a personal trading company, individual's personal trading company, and individual is an employee of the company, either part-time or full-time. Means normal sale of any asset is not considered as qualified for business asset disposal relief. The intention must be to close down the business. So, and secondly, about share, if shares are sold, they can be classified as qualifying business asset if they are in the individual's personal trading company, and in this company, the individual is also working as employee, either part time or full time. And what is mean by personal trading company? In which individuals has a 5% ownership of ordinary share or 5% of voting right. The ownership qualifying ownership period is 2 years. In every situation, it is said to be 2 years. For example, business must be owned at least 2 years before disposal. In case of shares, the individual should be an employee for at least 2 years or has a holding of company as personal trading company for 2 years. Assets that are qualified for the BADR relief must be owned for at least 2 years before disposal. So in this question, it is a factory, goodwill, warehouse and commercial investment property. Katie also sold her shares in an unquoted trading company and realized a gain of 4 lakh. She owned for 25% of ordinary share, which means 5% condition is met here, which she purchased 10 years ago. 2-year holding of shares, this condition is also met there. She has worked for the company on a part-time basis for at least 3 years. Again, working as an employee for at least 2 years, this condition here also met. Katie has not made any other capital disposal in the tax year 21-22, but she has capital losses brought forward of 7,800. She has never claimed any BADR relief in past. It means the whole 10 lakh BADR relief is available. Her only source of income is a trading profit. They have given us the trading profit. If we have to convert it into the taxable income, we have to deduct the 12,570 of personal allowance. After deducting this personal allowance, the taxable income lies in the basic rate band, and this would be 43,920 minus 12,570. His income is 31,350. And if we consider the unused basic rate band, this would be 6,350. But as a result of claiming BIDA relief, the individual has to sacrifice the benefit of unused basic rate band. So, presentation, while the non-qualifying BIDR asset like investment property is written on the separate column from the assets qualifying for BIDR relief. And the assets that are not qualified for BIDR relief, the capital losses and annual exempt amount are deducted from them. And after that, you can see that the total taxable gain from assets qualified for BIDR relief is 9,05,000, while asset that won't qualify for BIDR relief has a taxable gain of 1,80,200. So, asset that qualify for BIDR relief attract the tax at the rate of 10%, while the asset that won't qualify for BIDR relief attract tax at higher rate. Remember, this is not a residential property, so it will be taxed at the rate of 20%. Same is the case of this illustration, but in this illustration they have mentioned that Luca has previously claimed BIDR for qualifying gains of 4 lakh. So Luca disposed of business on November 21, realizing a net chargeable gain of 6,60,000. This is his gain that qualify for BIDR relief. He also disposed of holiday home residential property, realizing a gain of 21,200. So it would be recorded on the separate column. Lucas' taxable income is 40,000, means he doesn't have any unused basic rate band. So we recorded the asset that not qualify the BIDR relief on the separate column and deduct the annual exempt one from them. As we have a 6,60,000 of gain that qualify for BIDR relief, but remember that the 4 lakh of BIDR relief has already been claimed by the individual in the previous years. So the gain that is available to be claimed under the BIDR relief is 6 lakh. On this 6 lakh, the rate of tax would be 10%, while excess 60,000 will attract a 20% tax rate. As far as asset that won't qualify for the BIDR relief, this is residential property, that is why it attracts the tax at the rate of 28%. Here in this question, they have mentioned the record of 2 years. So we have to consider the fact that in the first year, the person is selling only one asset and realizing a gain. In fact, the person is selling warehouse and realizing a gain of 2,46,000. This gain won't attract the BIDR relief because intention is not to seize the business. So that is why the asset don't qualify for to be as a asset which is on which the BIDR relief can be claimed, but the condition that business should be seized is not met here, so that is why it won't be considered to attract a BIDR relief. Now about investor relief, BIDR is only available on disposal of share if the shares are in individual's personal trading company. Investor relief extends the benefit of BIDR relief to certain investors who do not meet the condition of BIDR relief. Now it applies to on the disposal of unlisted ordinary share in a trading company which are subscribed on or after 17th March and which have been held for a minimum 3-year period which starts from 6th April. And here the condition to be an employee is not necessary here. IR investor relief is subject to a separate lifetime limit, and that is 10 million. At this 10 million, 10% tax would be charged. So in this regard, we will consider the test understanding 5. Divide subscribe for 95,000 shares of one dollar ordinary share in DART Limited at par on 1st November 2018. Remember, date is important. Divide purchased a 6% shareholding in Beta in June 2019 for 40,000. In December 21, Divide sold the shares in DART Limited for 1,50,000 and shares in Beta Limited for 60,300. But remember, they are selling this on December 21. As far as shares in DART Limited are concerned, they have met the condition of holding 3 years period. So, gain on such shares would attract the investor relief. But as far as Beta Limited is concerned, the holding period of these shares are not 3 years. So, they won't attract the investor relief. This is a period from June 19 to December 21, which is a period of 2.5 years. So, it won't attract the investor relief. Both companies are unquoted companies, so this condition is also met. Divide has not previously claimed investor relief for business asset disposal relief and has a taxable income of 60,000. Now, rollover relief, which we have already considered in the previous chapters, previous topics, and for this, the gain arising on the disposal of qualifying business asset is deducted from the acquisition cost of a replacement asset, right? But provided that the net sale proceeds are fully reinvested. If the net sale proceed is fully reinvested, no tax is payable at the time of disposal. ROR in fact increases the gain arising on the disposal of replacement asset. Why so? Because the base cost of the new asset is reduced by the gain on the disposal of first asset. Gain may be rolled over number of times. If you have purchased a replacement asset and after a certain period of time you have sold that asset, and again the disposal proceed of second asset is again fully reinvested, then the individual can again claim the rollover relief. So it can claim by the individual number of times. When the deferred gain crystallizes, it is taxed at the appropriate rate applicable on that time. So, not the rate applicable at the time of deferral. The relief is not automatic, it should be claimed, and the period is within 4 years at the later of the end of the tax year in which the disposal is made or replacement asset is acquired. A disposal in the tax year 21-22 which is reinvested in 22-23 requires a claim by 5th April 27 because later date is the reinvestment of in 22-23 tax year. Condition: where a qualifying business asset is sold at gain, the taxpayer may roll over the gain provided the net sale proceeds are reinvested. Qualifying business assets are goodwill, land and building, fixed plant and machinery. Both an old replacement asset must be qualifying assets. Qualifying period is 1 year before and 3 years after, which means if the asset has been disposed of on 1st January 21, the qualifying period would start from 1st January 20 till 1st January 24. This is the period which is said to be the qualifying period. Gina purchased a warehouse in February 2010 for 170,000. She sold the warehouse for 3 lakhs, so it means a gain of 1,30,000 is recognized there. She sold the asset on July 21. In December 23, which is the qualifying period, Jenna bought a new warehouse for 3,60,000, which means the whole amount is fully reinvested. She planned to sell the warehouse in January for 5,50,000. So here we need to consider the 1,30,000 of gain would be postponed as a result of reinvestment, fully reinvestment, but the acquisition cost of 360,000 would be reduced by the 1,30,000 of gain on first asset and the base cost would be 2,30,000. And when this asset was, the replacement asset was sold for 5,50,000, it will be compared with the base cost of 2,30,000. Same is the case of test understanding 7. Remember that if there is a partial reinvestment, means the whole amount of sale proceed of first asset was not fully reinvested. In that case, the chargeable part of gain is the lower of. The gain that is chargeable is lower of amount of proceed not reinvested and full gain. Whichever is less is said to be your chargeable gain. Like in this question, Sharifa bought a factory in September 2005 and in December 21 wishing to move to a more convenient location. She sold the factory for 7,50,000. The cost of factory was 1,35,000. So gain is 1,15,000. This is the full gain. Then they have mentioned a condition if she has invested 7 lakh. If she has reinvested 7 lakh, it means the amount not reinvested by her is 50,000. So whichever is lower is chargeable gain. Their requirement of the question is calculate the amount of the gain which is chargeable. So in this question, in this first part, A part, the full gain is 1,15,000 and amount not reinvested is 50,000. Whichever is less is 50,000, which is said to be chargeable gain. While in second situation, the full gain is again 1,15,000, but the amount not reinvested is here 2 lakh because the asset has been sold for 7,50,000 and the new asset has been purchased for 5,50,000. So it is the amount of 2 lakh that has not been reinvested. So again, the chargeable gain is the lower of 1,15,000. Non-business use full ROR is only available only if the asset was used entirely for the trade purpose. Where the condition is not met, ROR is available but restricted in proportion to non-trade use. Like in this question, he only used 60% of the freehold building for the purpose of trade. He has acquired that building for 65,500 and sold it for 1,62,000. So it is a total gain of I think so 96,500, but out of which only 60% portion that is used for trade purpose qualify for the ROR. So it is the business proportion 57,900 which qualify for ROR, not the private use portion. Depreciating asset. Remember that ROR is modified when the new asset is depreciating asset. When the new asset is depreciating asset. In that case, we have to consider the 3 points. Until these dates, the gain is said to be frozen instead of rollover. This is said to be frozen. It is said to be deferred until the earliest of the following 3 events. First, the disposal of replacement asset or replacement asset cease to be used for the purpose of trade, which is normally the disposal date, and 10 years from the date of acquisition of the replacement asset. So here the deferred gain is not deducted from the cost of replacement asset and it is said to be frozen. And when the deferred gain crystallizes, it is taxed at the appropriate CGT rate applicable at that time. Again, not the rate applicable at the time of deferral. Prior to the deferred gain crystallizing, a non-depreciating asset is bought, then the original deferred gain can now be rolled over. Depreciating asset is said to be asset which is a wasting asset with a predicted life of 50 years or less, or an asset that will become a wasting asset within 10 years. The only depreciating asset that you would need to be aware of are fixed plant and machinery and lease property with equal to or less than 60 years remaining on the lease. Lily purchased a freehold factory in June 93 for 2,50,000. In May 2020, she sold it for 4,20,000, so realizing a gain of 1,70,000. In June 2020, bought fixed plant and machinery for 4,50,000. And in March 2022, Lily sold the fixed plant and machinery for 4,75,000. Calculate the chargeable gain arising on the tax year 2021 and 21-22, assuming Lily claim ROR relief where possible. Here the gain is frozen until the earliest of 3 dates, and 3 dates are disposal of replacement asset ceases to be used for purpose of trade. These 2 dates are normally same, and the 10 years from the date of acquisition of the replacement asset. So here the date of disposal is March 2022 and the 10-year period from the date of acquisition of replacement asset is from June 22. 10 years add, it would be June 2030. So whichever is earlier, March 22 or June 30. Obviously, it would be June 30, March 22. So the gain would be crystallized on March 22. The amount of gain is 1,70,000, which is deferred, not rollable. And now we have to consider that the sale proceed of replacement asset is 475. So gain of 25,000 is obviously crystallized on that date. But the original gain that has been deferred would also become chargeable on the same date, because March 22 is the date that is earlier. So the gain is crystallized until this date. Next is gift of a business asset, which is also said to be holdover relief or gift relief. The relief, however, is only available for qualifying business asset and gift for individual. Donor, the normal capital gain is calculated using market value as proceed, and the gain is not chargeable on the donor. It is deferred against the base cost of asset acquired by the donee. For donee, the acquisition cost is said to be the market value, and base cost is said to be acquisition cost less gain. Both the donor and the donee must make a joint claim for this relief, and for 21-22 gift, the claim must be made by 5th April 2026. On subsequent sale, again base cost would be compared with the sale proceed received in order to calculate the chargeable gain. The chargeable gain is taxed at appropriate rate, assuming the rates of CGT remain unchanged. The gain will be taxed at 10% of disposal, qualify for BADR from the donee's point of view, and UL rate depending on the level of donee's taxable income in the year of disposal and the type of asset. The relief is only available where there is a gift of a qualifying asset. Categories of qualifying asset is this: asset is used in a trade of donor or donor's personal trading company, uncoded shares and securities of any trading company, coded shares and securities of an individual donor of personal trading company. A company qualifies as an individual personal trading company if at least 5% of the voting rights are owned by the individual. But unlike BADR, there is no minimum holding period and no requirement for the individual to work for the company to qualify for GR relief. Tax planning in this regard: the outright gift of the qualifying asset result in no chargeable gain for the donor at the time of gift, but higher gain would be charged to the donee when the donee dispose of the asset, and that is tax on the appropriate rate, and that appropriate rate depends on the availability of donee's AEA, annual exempt amount, availability of BADR or IR from donee's point of view, and the level of donee's taxable income in the tax year. However, claiming GR is optional. It is not claimed. The gain arising at the time of gift is assessed on donor, which is taxed at the appropriate rate depending on the same factor but from the point of view of donor. So, the donor may choose not to claim GR. Why so? In order to crystallize a gain and utilize their own AEA, BADR, IR, so that the gain is taxed at 0 or 10% now rather than potentially at higher rate later. Now it is about sale at under value. For this we will consider this example. If the sale is at under value, the relief is modified as follows: any proceeds received that exceed the original cost of the asset gifted are chargeable to CGT on the donor at the date of the gift. The rest of the gain may be deferred. So, this is a comprehensive example. Ronald bought a warehouse on 4th July 2009 for 20,000. He gave the warehouse to his son Reagan, and on 1st September 2011. At that time, the market value was 52,000. Ronald and Reagan made a joint election to hold over any gain arising. Reagan sold the warehouse on 18 December for 95,000. So, this is the scenario. Now, their requirement is calculate the gain held over and the chargeable gain arising on the eventual disposal by Reagan in the tax year 21-22. So, here calculation is quite like a rollover relief. The market value of asset is 52,000 and the acquisition cost is 20,000. So, it is a gain of 32,000 which is holdover by the joint election of Ronald and Reagan. Then subsequently, when the Reagan sold the asset for 95,000, the base cost for Reagan, which was again 20,000, would be compared with the sale proceed. So first, it is from the Ronald's point of view, the gain is 32,000, but as a result of GR means gift relief, this is there is no chargeable gain. But subsequently, when Reagan sold that asset, the base cost for Reagan is again 52,000, the market value at the date of acquisition, less gain of Ronald gives a base cost of 20,000, and this base cost of 20,000 is compared with the sale proceed of 95,000. The second part has two requirements: calculate the gain eligible for GR and the base cost of Reagan, assuming all the facts same, but Reagan pays his father amount of 28,000. So if Reagan is paying 28,000 for an asset which has a original cost of 20,000, it means that 8,000 of gain has been earned by the Ronald. Apart from this 8,000 gain, remaining 24,000 would be deferred, means eligible for held over. So total gain is 32,000, but as actual proceed is greater than the actual acquisition cost, actual proceed from the point of view of Ronald, excess of actual proceed received by Ronald in excess of actual cost for Ronald 8,000, that is chargeable, remaining 24,000 is held over. And when Reagan sold that asset, the base cost for Reagan would be 28,000 and it would be compared against the 95,000. In the second part, they have mentioned that the Reagan has purchased that asset for 18,000. So in this part, there is nothing different from the first part of the question. The base cost would be 20,000 for Reagan and it would be compared with the sale proceed of 95,000. If asset is not used wholly for trade purpose, the relief is restricted, where either only part of asset is used for trading purpose or asset is used for a trading purpose for only part of donor's period of ownership. Only part of an asset is used for trading purpose means 1/5 of the building, you can say, or an asset is used for trading purpose for only part of donor's period of ownership, which means that the time period in months or in a year. Asset apart from shares, only the gain relating to the period that the asset was used in the trade or the part of asset used for trading purposes eligible for GR. The restriction to the relief operates in the same way as ROR, where assets have not been wholly used in the trade. Shares in the personal trading company, where the shares are gifted, the gain eligible to be held over is restricted if shares are the donor's personal company, whether quoted or not, and the company owns chargeable non-business asset. So in this situation, the GR means gift relief is available. Total gain multiplied by market value of chargeable assets, chargeable business asset divided by market value of chargeable assets. The difference between chargeable asset and chargeable business asset is that chargeable assets includes shares while chargeable business asset won't include shares. So in this question, Jinming has made a full-time working director of Prosleen Products since 1st December 2001 and purchased 10% of the company's ordinary shares on 1st December 2005. He resigned from the company in 2012 but kept the shares until 1st December 21, when he gave his 10% holding valued at 9,50,000 to his daughter, Jun Ying. The aggregate capital gain on the disposal of share was 7 lakh and both signed an election to hold over the gain on the gift. The market value of the asset held by the company at 1st December were land and building, motor car, cash, receivable, inventory, shareholders investment. So we need to calculate the Jinming's chargeable gain in the tax year 21-22 and the base cost for Janying. So it is a 7 lakh of total gain and GR would be claimed by 7 lakh multiplied by 5,50,000 divided by 6,10,000. Here 5,50,000 is said to be chargeable business asset and as we have mentioned earlier that chargeable assets include shares. So shares plus chargeable business asset give you a value of 6,10,000. So this is the formula, application of the formula. And what is the formula? Formula is market value of chargeable business asset divided by market value of chargeable asset multiplied by taxable gain. So this was release for individual, a very important chapter. Usually the part section C's first question is asked from this topic of relief for individual.